Welcome to the X Project Podcast. This is a podcast of the X Project Substack. To subscribe, please go to thexproject.substack.com. Why rate cuts, a lower US dollar, and inflation will all be returning soon. Revisiting fiscal dominance and the US policymakers' only choice. Article number 37. First, a note for podcast listeners. This article contains a large number of important charts and graphs. If you are not driving, you may want to open the article to scroll through to the charts to view while you listen. Again, only if it's safe to do. In this longer article, the X Project will answer these questions. Section 1. Why this article now? Section 2. What is the most significant issue? Section 3. What's the problem with it? Section 4. What's happening with inflation? Section 5. Why is inflation starting to rise again? Section 6. Why U.S. policymakers need higher stock markets? Section 7. How do U.S. policymakers affect equity prices? Section 8. Why is a lower U.S. dollar policymakers' only choice? Section 9. What does the X Project guy have to say? And as always, Section 10. Why should you care? Reminder for readers and listeners. Nothing the X Project writes or says should be considered investment advice or recommendations to buy or sell securities or investment products. Everything written and said is for informational purposes only, and you should do your own research and due diligence. It would be best to discuss with an investment advisor before making any investments or changes to your investments based on any information provided by the X Project. Section 1. Why this article now? Last week, the X Project published The Rising Tide of Global Liquidity Lifting All Assets, Michael Howell's powerful analysis and provocative forecast, article number 35, in which his view on rising asset prices was summarized. The genesis of that article goes back another week when the X Project originally started writing an article on some non-consensus opinions on why the stock market may continue rising and why the economy may avoid a recession. However, with the market closing at new all-time highs 2 weeks ago, the X Project's contrarian soul pulled in another direction, and Market Rules to Remember, Bob Farrell's Legacy Applied to Today's Market, article number 33, was published instead. So, this article continues with some non-consensus views on why the stock market may continue rising without a recession. Still, the story here is a bit more complicated and ultimately has to do with a far more significant issue that will have much bigger consequences than higher stock markets and avoiding an economic recession. Section 2. What is the more significant issue? U.S. federal debt and deficit. The most significant issue facing us, our society, our government, our economy, our financial markets, and our overall standard of living is the U.S. federal debt and deficit. Everyone should know that the U.S. has a significant debt and deficit issue. Here are some charts and figures to provide context, looking at the total debt first, and then the federal budget deficit. According to the Congressional Budget Office's latest report, here is a historical view of federal debt held by the public, along with projections going out to 2054. Federal debt held by the public increases each year in CBO's projections, swelling to an all-time record of 116% of GDP in 2034. In the 2 decades that follow, growing deficits caused debt to soar to 172% of GDP by 2054. Here is a chart of the total federal debt from 1966, starting at $321 billion through Q3 of 2023 at $33.167 trillion. Here is the current total U.S. federal debt and breakdowns per citizen and taxpayer according to the real-time U.S. national debt clock as of 9:33 a.m. Central Time on February 24th, 2024. U.S. national debt is $34,287,568,530,217, which breaks down to $101,978 of debt per U.S. citizen and $265,178 of debt per U.S. taxpayer. Now, let's look at the federal budget deficit and start with the Congressional Budget Office's latest report with a historical view along with projections going out to 2034. In CBO's projections, the total budget deficit, the amount by which outlays exceed revenues, equals 6.1% of GDP in 2034. Net interest payments grow in relation to GDP, reaching 3.9% of GDP in 2034. Primary deficits, which exclude net outlays for interest, increase in 2025, decline over the next few years, and then increase again. Here is a longer historical view of the federal budget deficit or surplus going back to 1929 through the end of fiscal year 2022. And here is the current total U.S. federal budget deficit according to the real-time U.S. national debt clock as of 10 a.m. Central Time on February 24th, 2024. U.S. federal spending, official, $6,445,162,807,520. U.S. federal budget deficit, official, $1,768,547,562,225. The actual U.S. federal spending is $6,586,646,612,523, with the actual U.S. federal budget deficit at $1,910,031,378,237. Section 3. So what's the problem with it? The U.S. Treasury market. The problem with the U.S. debt level and the current and future federal budget deficit is that the money has to come from somewhere. The primary way that the government borrows money is to issue and sell U.S. Treasury bills short-term, notes medium-term, and bonds long-term, and someone has to buy them. The primary concern with the current setup is who has the cash and balance sheet capacity to buy trillions and trillions of U.S. debt. The U.S. Treasury must issue approximately $1+ trillion in net new debt to fund the remainder of the current year's budget deficit, plus nearly $9 trillion to refinance maturing U.S. treasuries. Restating the problem another way is that there may be far more supply of U.S. treasuries being issued than there is demand. How do we know when we start seeing this problem? One way we know is when the U.S. Treasury auctions go badly. And this past week, the U.S. Treasury auctioned $16 billion in 20-year notes that produced very ugly results. The mechanics of U.S. Treasury auctions are a bit complicated and beyond the scope of this article. But if you are interested, James Lavish, CFA, has a thread on X Twitter that explains Treasury auctions that can be found at the link in the written article. And here is Lavish's description of this week's auction. Quote, "Another spicy Treasury auction, this time in the 20-year. Tail was 3.3 basis points, largest on record for the 20-year. Foreign bidders dropped to under 60% from 74% in November. And dealers were saddled with 21% of the auction, double from November. In a word, ugly." End quote. What happens when the supply of something increases, when demand is the same or decreases? According to Economics 101 and the basic supply and demand curve, prices will decrease. And if that something is a bond, what happens to its interest rate? It rises. While the Fed sets and controls the federal funds rate, the shortest of short-term interest rates, the market sets all other interest rates based on the economic laws of supply and demand. For all these reasons, the X project is bearish, long-dated U.S. and other Western sovereign bonds. Section 4. What's happening with inflation? Higher for longer. Let's pull on a different string before returning to the federal debt deficits and the Treasury market. On Tuesday, February 13th, the Bureau of Labor Statistics, or BLS, released January's latest Consumer Price Index, or CPI, data. On Friday, February 16th, the BLS released January's latest Producer Price Index, or PPI, data. Both reports came in hotter than expected on every indicator, and the table below summarizes the data. Here is a chart of Supercore CPI, a recent favorite of the Fed, showing, white line, that it bottomed in October of 2023. It has been rising since then, and as of January, is accelerating. The X Project is not surprised by this. On January 27th, the X Project posted a note on Substack with these charts, courtesy of Hedgeye. Section 5. Why is inflation starting to rise again? Fiscal dominance. The X Project first introduced the concept when it published Fiscal Dominance, What the Heck Is It and Why Does It Matter? Article number 6 in November 2023. The X Project revisited the topic when it published An Introduction to Inflation, What is its relationship to interest rates, government debt deficits, and fiscal dominance? Article number 9, also in November. The latter article outlined that the three most common factors causing inflation are increased demand for goods and services, reduced availability of goods or services, and or an increase in money supply. Regarding the reduced availability of goods or services, some impacts may start showing up related to shipping delays and increased shipping costs due to the situation in the Red Sea and reduced capacity due to low water in the Panama Canal. Still, no one is suggesting these are factors make an impact, at least not yet. As for increased demand for goods and services, the economy continues to be resilient, posting an annual growth rate of 3.3% in the fourth quarter of 2023, down from a robust 4.9% in the third quarter of 2023. The Atlanta Fed's GDP Now forecast for the first quarter of 2024 is currently at 2.9%. Demand for goods and services continue to grow, albeit at a slower rate. And then there is the money supply. You may have heard that one measure, M2, has been contracting the fastest since the Great Depression. However, M2 is a narrow definition of money that does not distinguish between financial and real economy money. Alfonso Pacatiello, otherwise known as ELF, posted a great thread on X or Twitter yesterday explaining this and more, including, quote, if the government spends more than it plans to collect in taxes, for new money has been created. Deficit spending increases the net worth of the private sector without adding a liability to it. And below is a chart showing this dynamic. Moreover, the federal government's fiscal spending creates demand in the economy, keeping it from falling into a recession despite higher interest rates. Furthermore, the interest payments on the federal debt are approaching $1 trillion, and that money is being returned to the economy, which is ultimately stimulative. The irony is that higher interest rates create those higher interest payments. As Luke Roman, who taught me almost everything I knew about fiscal dominance, says, quote, fiscal dominance is the growing supremacy of fiscal policy over monetary policy in shaping economic outcomes, end quote. Section 6. Why U.S. policymakers need higher stock markets. Tax receipts. Okay, let's start knitting the different threads of this article together. Luke Roman also identified the critical correlation between stock prices and tax receipts, and this is a chart similar to one he has shown many times in his work. And since the U.S. Treasury and Federal Reserve no doubt know and understand this relationship, it has become a powerful incentive and tool for them to use. If there are more tax receipts, there will be less of a deficit and therefore fewer U.S. Treasuries that must be supplied to the market. Section 7. How do U.S. policymakers affect equity prices? The U.S. dollar. You may have thought the answer was interest rates. But if you read the X Project's article published in December, everyone is missing the point about the Fed's rate cuts in 2024. What is the point? What does it mean? And what can we expect? Article number 17, in which the Federal Reserve's ultimate and primary mandate of keeping the U.S. Treasury market functioning was discussed. And yes, interest rates are part of the answer. But remember, the Fed only directly controls the federal funds interest rate, which is the interest rate at which commercial banks borrow and lend their extra reserves to one another overnight. The federal funds rate impacts the rest of the U.S. Treasury yield curve, but the impact is strongest at the shortest end and weakest to non-existent at the long end. The real economy, as highly financialized as it is affected more by longer-term U.S. Treasury rates set by the market. As was pointed out in the article above, when the MOVE index, a U.S. bond volatility index, spikes, the Fed and/or U.S. Treasury respond by injecting U.S. dollar liquidity into the system to keep the U.S. Treasury market functioning, meaning there are buyers for our bonds. This has now happened 5 times since 2019. But the question here is about equity prices. How does the US dollar affect equity prices? Again, we turn to Luke Roman, who found this chart courtesy of Jeremy Schwartz, Global Chief Investment Officer at Wisdom Tree Funds on X or Twitter. And it shows the rolling 3-year correlations between bonds versus stocks and US dollars versus stocks. Since 2008, Luke Roman's red arrow in the chart above shows, quote, the US dollar and stocks have never again been positively correlated. When the US dollar gets too strong, stocks go down, end quote. Section 8. Why is a lower US dollar policymakers' only choice? The alternative will blow up the global monetary and financial system. Luke Roman explains this in his January 19th Tree Rings report. What changed in 2008? The Fed's actions to save the banking system, zero interest rate policy, and quantitative easing turned the US dollar into more of a global funding currency as foreign US dollar denominated debt rose from 5 trillion to 13 trillion in 15 years, per the BIS or Bank of International Settlements in the chart below. While they were borrowing US dollars with one hand, foreigners were buying US dollar denominated assets with the other. This drove the US net international investment position from negative 15% of GDP in 2008 to negative 65% in 2023, and amounted to the US hawking the family silver, equity stakes of finite assets like equities and real estate, to fund the US economic recovery. And below is a chart of the US net international investment position as a percentage of GDP, with a note that says, running the USD wrecking ball with US net international investment position at negative 50% to negative 70% of US GDP, which is 2018 to the present, has repeatedly proven to be a very different proposition than running it with a US net international investment position at negative 20 to plus 10% of GDP, which occurred from 1976 to 2012. Most investors are still operating on the first principles basis as if US NIIP is like it was 1976 to 2012, rather than how it is now. Foreigners are not short USDs because they are net long $18 trillion in US dollar assets, including 7.5 trillion in US treasuries, that they will sell those assets aggressively to raise US dollars if needed. This is likely a major reason why the US recovery outperformed much of the rest of the world post-Great Financial Crisis. But now the devil has arrived to, quote, take the hindmost, end quote, as Edward Chancellor wrote. He usually does in such cases in his book by the same name, Devil Take the Hindmost. The chart above from Jeremy Schwartz intimates why and how the devil will now take the hindmost. The US dollar is highly negatively correlated to stocks. But as we saw in 2023, stocks are highly positively correlated to US tax receipts, which are in turn negatively correlated to US Treasury issuance, which is in turn positively correlated to interest rates, which in turn positively correlated to the US dollar, which is per above negatively correlated to stocks. The 35-year record high positive correlation between bonds and stocks, combined with a near record negative correlation between US dollar and stocks, is, failing a productivity miracle, mathematically certain to drive a US debt spiral in the context of how US policymakers have allowed the system to evolve since the Great Financial Crisis. The gap between bond, stock, and US dollar stock correlations in the chart above means that the global monetary system will unravel quickly anytime the Fed and Treasury fail to supply whatever US dollar liquidity is needed whenever it is needed. This is how the devil is going to take the hindmost, and consensus remains in dogmatic denial about this, even as this reality manifests itself in an increasing number of indicators, including via the chart above. The chart above shows that both stocks and US Treasuries are now risk-on assets, while the US dollar is the risk-off asset, and that for stocks and bonds to rise, the US dollar must fall. The chart above in section 6 shows that the US government needs stocks and bonds to rise in order to keep tax receipts up, and stocks and bonds must rise, so the US dollar must fall. We have faith in Yellen, Biden, and Powell's ability to make the US dollar fall in the first half of 2024. We continue to believe gold, Bitcoin, and industrial equities will be the biggest beneficiaries. More US dollar liquidity will also support long-term US Treasuries and bonds more broadly, but they will likely fall on a real basis versus inflation and likely fall significantly versus gold, Bitcoin, and stocks. Let's watch. End quote. Section 9. What does the X Project guy have to say? First, this article is longer than most, so I will keep it short. This article already said what I must say, as it explains why inflation is not going away, and my views and investment positions on 8 of the X Project topics: commodities, economics, energy, government debt and deficits, interest rates, markets, and money. Second, I want to thank all subscribers, primarily free and some paid, who have signed up thus far. Gaining additional subscribers daily is a decisive vote of confidence propelling the X Project forward. Substack tells me that nearly 2/3 of you have a 4-star or 5-star activity rating, meaning you consistently engage with my content, which is excellent. Please hit the heart icon, indicating you like the article. The more likes I get, the more Substack will promote my content within the Substack community. If you don't like my content or have any suggestions, please email me at thexprojectguy@gmail.com. Lastly, in the next section, I will explain further why you should care and, more importantly, what you can do about it. However, the X Project now requires you to view the final section as a paid subscriber. In a few articles, the paywall will move up within the article so that only paid subscribers will see the last 2 sections, or rather, free subscribers will only see the first 8 sections. I will be moving the paywall up every few weeks, so ultimately free subscribers will only see the first 4 or 5 sections of each article. Please consider a paid subscription. All paid subscriptions come with a free 14-day trial, and you can cancel anytime. Every month, for the cost of 2 cups of coffee, the X Project will deliver 2 articles per week, helping you know in 1 to 2 hours of your time per month what you need to know about our changing world at the intersection of commodities, demographics, economics, energy, geopolitics, government debt and deficits, interest rates, markets, and money. You can also earn free paid subscription months by referring your friends. If your referrals sign up for a free subscription, you get 1 month of a free paid subscription for 1 referral, 6 months of a free paid subscriptions for 3 referrals, and 12 months of a free paid subscription for 5 referrals. So please refer your friends. Thank you. This concludes the X Projects podcast number 37. Please subscribe to the X Project Substack at thexproject.substack.com.